I think that 2024 is going to be a surprisingly good year. Historically, good years follow great years.
2023 was certainly a great year for investors, with the S&P 500 up 24%. That's a gain of £240 for every £1,000 that you had invested in the market last year, which is pretty insane. And if you somehow managed to lose money in 2023, then you're doing investing wrong. So today I'm going to reveal all of the major predictions for the stock market this year. But more importantly, I want to reveal to you guys some of the major themes that you need to stay close to that could be hugely influential on the market and its performance throughout 2024. I'll speak to both sides of the argument, whether you're in the bull camp or the bear camp, and I'll give my thoughts at the end of the video too, so be sure to stick around for that. So let's kick things off with the bear case. This is one that nobody wants to hear, but it's always a possibility. The markets haven't had the best start to the year. In actual fact, they've had their worst start since 2016. And just like in 2023, all eyes are on the Federal Reserve to see what they're doing with their monetary policy throughout 2024. Until the picture becomes clearer, markets still may be a little bit shaken. At the point of recording, the S&P 500 is down 0.75% and the Nasdaq is down 1.6%. And just to throw in a fun theory here, there is something called the January Barometer, which was something that was referenced in a book called The Stock Trader's Almanac. Now, based on market data from 1928, it states that there is a correlation between January market performance and the rest of the year. So whatever the markets look like come the end of Jan could very much be a good indication of what the market is going to do for the remaining 11 months thereafter. But hey, less about theories, let's now talk fundamentals and facts. Right now, the forward PE of the S&P 500 sits at 21.5 times earnings, which for context is 19.4% above historical averages, which are about 18 times earnings. Damn! But of course, that's the whole market that we're assessing, and actually when you dive into the different sectors, that's where some problem areas certainly become apparent. Here you can see the forward PE of all of the sectors across the US economy. You've arguably got value in energy, financials, materials and utilities, whereas the likes of consumer cyclical, healthcare, tech and especially real estate are trading at a premium. Now you may be thinking, well, valuations don't necessarily mean greater returns, which for the most part you'd probably be right. Tech pretty much has and probably always will trade at somewhat of a premium, but despite that it provided returns of 57.8% last year, whilst financials on the other hand, arguably a value play last year, only returned 12.2%. But what I would be more cautious about is something called the Magnificent Seven, which are 7 tech-related companies over in the United States, which actually provided most of the returns for the S&P 500. And due to that, those 7 stocks actually make up a whopping 27% of the total market capitalization of the S&P 500, meaning any upside or downside in any of these 7 companies could materially affect the total performance of the S&P 500. So with tech trading at a bit of a premium right now, thanks to last year's performance, we could see some investor appetite shift away from these stocks as they re-enter into different parts of the market in order to rebalance their investment portfolios. So if you're like me and you've got a big portion of your investment portfolio weighted towards tech, then it may be a tricky start to the year if tech underperforms. It's easy, obviously, to point the finger at tech, but actually the whole market in itself is trading at a premium. The S&P 500 just eclipsed a new all-time high at the back end of the year, closing at 4,800 points. The market gained over 11.5% just in Q4, and that's thanks to growing optimism around monetary policy and the potential that the Federal Reserve could begin to cut rates. Now, a rate cut is of course positive for the market and market returns, especially during this kind of transitionary weird phase in the economic cycle that we appear to be in. Lower rates as a result of lower inflation should potentially result in higher profit margins, which should only boost stock prices, hence the market reaction at the back end of 2023. But there's certainly an argument here that the market's priced in too much optimism, and that actually we would need to see some kind of perfect market conditions and a perfect cycle of rate cuts in order to maintain the current levels of momentum that we've seen. Right now, CNN's Fear and Greed Index is firmly in the greed camp. And as we all know that famous quote from Warren Buffett, be fearful when others are greedy, and greedy when others are fearful. So is now the time to be cautious in 2024? Well, be sure to let me know your thoughts down in the comment section below. Now, whilst you share your predictions, now let me share some of the analyst forecasts who share some of the same concerns I've just discussed. Starting off with JP Morgan, who have a price target of 4,200 points, which is a decline of 10.6% from current market prices. Quoting, equities are now richly valued with volatility near the historical low. while geopolitical and political risks may remain elevated. We expect lackluster global earnings growth with downside for equities from current levels. Then we've got Morgan Stanley with a price target of 4,500 points, a decline of 4.2% from current market prices. Stating the question for all investors at this stage is whether the leaders can drag up the laggards to their level of performance, or if the laggards will eventually overwhelm the leaders' ability to keep delivering in this challenging macroeconomic environment. So there's some of the bear market stories. Now let's dive into the bull market stories, which are certainly the stories that you're all certainly going to want to hear. The S&P 500, as I said, hit all-time highs in 2023, a milestone that I don't think anybody thought was possible or perhaps even practical at the start of the year, especially driven by the macro environment. However, as things stand at the moment, momentum seems to be in the favour of the markets, and that's despite the valuation story. Forward earnings valuations of the S&P 500 are historically high, and they've only been pushed higher on the basis of a Fed tightening program. And I think in a sense we can kind of bank on this playing out. We're now in this kind of recovery phase of the cycle, if you like, with inflation now coming back under control, without ever really entering a recession of sorts, which so many forecasters predicted. And this is positive for the stock market. According to analysts, the market actually tends to increase by 14% in the 11-month period between the last rate hike and the first rate cut. Now, the last rate hike was on July 26, 2023, and since then markets have actually only risen by just under 3%. So with this thesis in mind, a rate cut or several rate cuts this year could be a massive upside catalyst for stock market performance. On the topic of upside, now I want to talk returns.
Show me the money!
Because whilst we talk a lot about valuations, they're actually a pretty poor predictor of stock price performance. On this chart from Robert Shiller, it shows the relationship on the 1-year performance of the S&P 500 between 1871 and 2022, with the P ratio at the start of that year. And you can see how the returns are distributed completely randomly. For the most part, P ratios seem to sit anywhere between 5 to 40 times earnings, but the preceding years thereafter can be positive or negative, and don't really have any correlation on performance in the short term whatsoever. And actually what I think is most important is the compound effect on returns. Because from this data shown from the Wall Street Journal, it shows that actually if you invested $1,000 at any point in the past 150 years in the US stock market, based on average returns over any 10-year period, you would have doubled your money. And that's the underlying point here, and in my opinion, why everybody should be investing. Because regardless of what the market does today, tomorrow, next week, or next year, over the long run, the market always wins. Earnings and growth in stock prices are directly correlated. So a year of positive earnings growth in 2024 is an absolute must if we want to see upside performance. And as we enter into the earnings season once again in a couple of weeks' time, that picture will become ever more clearer, especially when we start to hear from company execs summarize their performance from Q4 last year, but also give a little bit of a signal of what their expectations are for the year ahead. Now, profits from the fourth quarter are projected to have risen by 1.3% from the same period a year earlier, and Wall Street is expecting that earnings will grow sharply during 2024, with analysts expecting a growth in profits of companies in the S&P 500 by about 12%. Now, as I referenced earlier, big tech will have a major role to play in the upside performance of the stock market. So I'll certainly be staying close to the tech earnings over the coming weeks ahead, as they could have a big bearing on what's to come. A popular investment last year was money market funds, with nearly $6 trillion of inflows by the end of 2023. And investors last year were fairly happy to collect their 4 or 5% stable yields. But with the overperformance of the stock market last year, actually investors that took the more cautious approach to their investments lost out on some 20% worth of upside. And with an evolving interest rate climate, with the potential that rates could actually start to taper off, actually money market yields may also fall too, meaning we may see money unwinding from these money market funds and being redistributed back into capital markets, which of course would further promote stock price growth. For context, the S&P 500 has a market capitalization of $39.4 trillion. So even if we saw an unwinding of a couple of $1 trillion away from these money market funds, that would still have a material difference to the total value of the US stock market. However, one thing that analysts do think will make a major difference this year is artificial intelligence.
I think we're entering a 3 to 5 year tech bull market. This is powered by AI. This is not about interest rates.
The growth in AI very much fueled a recovery for tech stocks in 2023, after the tech wreck of 2022. And the reason for this is, well, forecasters suggest that the AI market could be worth upwards of $1.8 trillion by 2030, which is an 800% gain between where we are now and where we're going to be at the end of the decade. That is a monumental amount of upside on the table. With AI comes higher levels of productivity, better decision making, streamlining of operations, optimization to deliver competitive advantages, which are all likely to lead to higher profit margins. The list of AI advantages is endless, and the companies that use it will flourish, and the ones that don't will be the Woolworths and Blockbusters of the early noughties. So in support of all of that, here's some expert predictions for 2024. Starting off with Goldman Sachs, who have a price target of 5,100 points, which is an upside of 8.5%. With them quoting decelerating inflation, corporate profits on the rise, and the Fed shifting to a more dovish position, supporting their price targets for 2024. Next up, we have Yardeni Research, with price targets of 5,400 points, an upside of 14.9%. The forecast is supported by the firm's Roaring 2020s thesis, in which they expect the advancement of AI and robots, which will make companies more efficient and profitable. But for completeness, here are a list of the price targets I've noted for 2024 whilst researching for this video. So look, I've listed more reasons to be positive than negative, which I guess is just my outlook on life more generally. Naturally, I'm an optimist, but I don't like to think I'm delusional. The reality is, whilst I'd like to firmly sit in the bull camp, I'm obviously fully aware of the broader macroeconomic risks at play. But with that being said, macroeconomic risks have and always will be prevalent in any market conditions at any point in time. And the reality is, I don't really know what the markets are going to do this year. Even the highest paid market analysts simply can't agree with each other, so what chance do I stand? Instead, I'll simply remain objective about the long-term performance of my own investment portfolio, and one of the core ways for me to achieve my financial goals is to simply continue investing into the stock market in order to grow my wealth over time. It's what I've been doing for the past 6 years now, and I've just surpassed an investment portfolio value of over £100,000. So it's working out pretty well for me so far. Now, if you are interested in my current public portfolio, then be sure to click on this video next to check out my latest update. But before you go, be sure to subscribe to the channel on your way out if you want to grow your wealth in 2024. And with that being said, I'll see you over in the next one.